PE tells you the price. PG tells you whether it's worth it. Most investors stop at the PE ratio. That's usually where the analysis ends. The problem is that PE only tells you what you're paying for a company today. It doesn't tell you what you're getting in return. That's where the PG ratio comes in. The formula is simple. Divide the PE ratio by the earnings growth rate. It helps answer a more important question. Does the company's growth justify its valuation? As a general rule, a PG below may first suggest undervaluation, while a PG above 2 deserves extra caution. It's not a hard rule, but it's a useful starting point. Take NVIDIA. The stock trades at roughly 31x earnings, which many investors would immediately label as expensive. But earnings grew more than 100% over the last 12 months. That brings the PG ratio down to around 0.29. Looking only at the PE misses the bigger picture. The market wasn't just paying for today's earnings, it was paying for exceptional growth. Now look at Ion Exchange India. The stock has often traded around 30-40x earnings and operates in a sector with strong long-term tailwinds. On the surface, that sounds attractive. But recent results tell a different story. EBITDA declined sharply, core operating profitability weakened, and earnings growth has been flat to negative. A high PE can be justified by growth. Without growth, it becomes much harder to justify. Then there's Suzlon. Its trailing PG appears expensive because the growth calculation is distorted by years affected by financial distress. In cases like this, historical numbers can be misleading. The company now has a large order book, a net cash balance sheet, and benefits from rising wind energy investment. Sometimes the future matters more than the past. The lesson is simple. PG is a tool, not a verdict. A stock isn't cheap because its PG is low, and it isn't expensive because its PG is high.